In this month's economic update, Kaplan Professionals' Trevor Trahan speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Trevor Trahan, and this month we're joined by HSBC's Chief Economist for Australia and New Zealand, Paul Bloxham. Thanks for joining us today, Paul.
That's fine.
The RBA kept interest rates at 2% at its August board meeting. When do you expect the rates to move next?
We think the RBA is going to be on hold for quite some time yet. They are still managing this rebalancing of growth, mining investment still falling, and they're trying to support growth in the non-mining parts of the economy. They're having, in our view at least, some success in doing that. The housing market's picking up quite strongly. Housing construction's lifting as well. That appears to be feeding through to a bit more consumer spending, and indeed you're seeing some signs that the services sectors are picking up as well, and that's what we think will be the next driver of Australia's growth. But that mining investment decline has still got further to run, and certainly it will take some time until we're fully rebalanced. We think that full rebalancing of growth won't really have happened until at least 2016, or maybe in the latter part of 2016 or into 2017 potentially as well. So we think the RBA is unlikely to be doing anything with its interest rate setting anytime soon. We think interest rates will stay where they are, and the RBA will rely on the Aussie dollar falling further to continue that rebalancing of growth.
How do you think the Australian dollar will perform between now and the end of the year?
Well, the Aussie dollar, we think, has probably got a bit more downside yet to come, although saying that, it's worth keeping in mind the Aussie dollar has come down a long way already. We're sitting around 73 cents. We're down from a peak of 110 at one point in time in 2011. We averaged about 104 through 2011-2012. So it has come down a long way already. And we think the bulk of the sell-off in the Aussie dollar has already happened. So we think the Aussie dollar could head down to 70, maybe a bit below that. There's a risk that it could fall below that. But we don't think that we've got very much yet of a depreciation yet to come. We think most of that depreciation has already happened.
What is your take on the housing affordability issue in Australia?
Well, it's certainly an issue in the sense that house prices are quite high in Australia, certainly when you compare them to incomes, and that's definitely the case in our major capital cities. The housing affordability issue is a very tricky one, though. Housing demand is strong, and strong demand is not met with enough supply, and that's pushed up house prices. They're at high levels for fundamental reasons. They're not at high levels because of other factors. We think it's to do with fundamentals. We do think demand is strong, it's meeting weaker supply than is required. And so in order to try and fix that affordability issue, it does require some deeper sets of policy. Things like allowing greater urban infill, allowing greater land release on the urban fringe as well, and potentially building a lot more infrastructure, particularly urban infrastructure in the major cities, which might allow people to be able to feasibly live further out and still commute in a reasonable time to the middle of the major cities. So we do think that there is an affordability issue. We think it's not easily fixed, and we do think that the main focus in terms of fixing it ought to be on the supply side and those supply side policies rather than trying to do something about demand, which demand is strong for good reasons. Demand is strong because Australia is an attractive place to live, and our major cities are seeing strong demand for housing.
China's stock market suffered a significant dip in July. What impact will that have on its wider economy?
Well, certainly there's a great deal of uncertainty about how much the stock market will impact the Chinese economy and what it might mean. We know that the Chinese stock market has risen substantially, more than 100% over the past year, and then, as you say, it sold off quite aggressively in July, and now it's been very volatile in recent times, partly because the authorities have taken some measures to try and stabilise the stock market, and that is partly adding to the volatility in the market as well. What it means for the overall economy, it's very hard to know because the stock market is actually only a fairly small proportion of the overall economy. There isn't actually a great deal, there aren't that many households that have that much exposure to the stock market. And when you think about it, although the stock market's come down since its peak, you didn't see a strong pickup in growth when it was rising substantially either. So you wouldn't necessarily expect to see a reversal and therefore a decline or a very sharp decline in growth as a consequence of the fall, given we didn't see a run-up when we saw the stock market rising. So it's certainly an issue and something that's added a fair bit of volatility into markets. It's likely to be having an impact on commodity prices in particular, which have sold off quite aggressively in the last month or two. But we don't think it's going to have an overall big effect on Chinese GDP growth, partly because it's only a small proportion of the overall Chinese economy. And so we don't think the overall effect on GDP will be particularly large.
How will that Chinese stock market fall impact the rest of Asia?
Well, certainly the volatility in the Chinese stock market is having an impact on markets across Asia, and any sort of slowdown that it might deliver in Chinese growth, although we think that the authorities will have sufficient capacity to be able to try and support growth. We think that the Chinese authorities have already started to pull the levers on infrastructure investment, and that's going to more than offset the decline that we're likely to see from the impact of the volatility in the stock market, so that we think they will get very close to their target for 7% growth for this year. If the Chinese stock market impact is as muted as that in terms of its impact on the Chinese economy, it should have a fairly limited impact on the rest of Asia in terms of their growth prospects. Although, as I said, it has had an impact on the volatility in a lot of the markets across Asia.
Which regions of Asia do you expect to witness strong growth over the next 12 months?
Well, that's a hard question, because in the scheme of things, we really don't have in mind that there are any parts of Asia where you will see exceptionally strong growth. Probably the only country which is really seeing an acceleration in its growth is India. India had a change of government last year. The Modi government's got a reformist agenda. The GDP numbers have already been rising, and we think that that's going to be supportive. We think the Indian economy will have support from the ongoing reform agenda that Modi has in mind. Infrastructure investments are a key part of that story. In fact, we think India will outpace China this year and into next year. So across all of Asia, it's probably the one country where you can say actually things are turning around. The other economies, a lot of them are highly dependent on what's going on in China, and China's growth has slowed, so it's hard to think that those countries are necessarily going to outperform. India would be my pick.
The US economy regained its footing in the second quarter, expanding at an annual rate of 2.3%. What caused this performance?
Well, firstly, it was a rebound after the first quarter. First quarter GDP in the US was particularly weak, and a part of that was the impact of weather. So it was severe weather in the early months of the year, had held back production and held back spending, and there was some bounce back into the second quarter. If you look at the components, one of the key things supporting growth was consumption. We probably haven't seen enough of a pickup yet in business investment to be really confident that the business sector is really starting to ramp up their investment yet. But if you look at the GDP numbers for the US as a whole and say, well, it's running at 2.3% year on year, and that's about what you got in the quarter, that's approximately trend growth for the US. So the US economy is running at about trend. The other thing you can say is when you look at the labour market statistics, they suggest that they also confirm that the US economy looks as though it's pretty close to full employment. So the really important thing, and the thing that markets are all watching at the moment, is when, as a consequence of an improvement in the economy, the Federal Reserve might start to consider lifting interest rates. And we think that will come before the end of the year. We do think that the Federal Reserve will start to lift interest rates before the end of this year.
However, US factory activity slipped in July and consumer spending advanced at its slowest pace in 4 months in June. How much of a concern are these results?
Well, certainly the data on a monthly basis have been quite mixed for the US, but they're equally that you can point to things that have been weaker. There have actually been some indicators that have been much stronger as well. The non-manufacturing ISM indicator, which is an indicator of mostly services sector sentiment, actually hit a record high just recently. So there are signs that things are improving. The improvement has been a slow road. The US is on a very slow road to recovery. But we think there will be just enough of a pickup in demand and just enough of a recovery in the US to see the Federal Reserve start to lift its interest rates before the end of this year.
What will be the key driving factors behind further US economic recovery?
Well, a pickup in business investment is something that we are all looking for. Certainly if you look at the balance sheets, the household balance sheet is still quite indebted. So households, although they have started to do a little bit more spending, it's hard to believe that the household sector is going to be a really strong driver of growth. Certainly trade hasn't been necessarily a large contributor, and the strengthening of the US dollar is something that has seen trade not contribute as much to growth in recent times. So what we're looking for is if you look at the balance sheet of the business sector, they're sitting on a large amount of cash. They've deleveraged, and the key question is when does the business sector see enough signs that demand is likely to pick up in the future, to feel like it might do a bit more investment, we think that there is a good chance that that investment will start to pick up gradually over time, and that will be a contributor to growth as the US economy continues to recover.
What do you expect will be the longer-term implications of the debt situation in Greece?
Well, certainly it's been a big issue this year, and it was a big issue back in 2011 and 2012, and those challenges still remain. The important thing, I guess, about the Greek story, and the one to really keep in mind, is that Greece is a fairly small economy in the scheme of things, and the rest of the euro area is actually looking a fair bit better. The PMIs have been improving. The European economy looks as though it's in an upswing. That's being driven partly by the fact that oil prices have come down, and that's been quite beneficial for Europe. The euro's come down, and that's been helpful. And of course, the ECB embarked upon its quantitative easing program this year. So there's a significant liquidity within the system. The European economy in general is lifting, and that's been helpful to essentially allay the fears that the Greek issue could become something that was a bit more systemic for the whole of the euro area. Greece remains a point of contention and something that markets will continue to watch over time, and I suspect that there will be trigger points that mean that it will come back into focus at various points in time. But I think Europe has managed to get through this period, and the euro has managed to stay in reasonably good shape, and that's a positive sign.
How have other markets around the world been impacted by the Greece situation?
Well, certainly Greece, when the issues were most pointed over the last couple of months, had a big impact on global markets. They were impacting markets in the US, they were impacting markets in Asia, and the Australian market got affected by that volatility as well. What was interesting about that episode, of course, is Greece itself is so small that it isn't really a big impact in and of itself. It was the risk that was being priced of the possibility that if Greece was to leave the euro, what that might mean for the rest of the euro area. As we've gotten past this episode and Greece hasn't left and the euro area has held together fairly well, and the European indicators have held together fairly well, they've looked fairly positive, in fact, it seems likely that Greece will become less and less of an issue over time, because the markets are convinced that the euro European economies are doing better.
Debt remains a factor for several EU economies. How will that trend be reversed, if at all?
Well, certainly there are countries in Europe that have high levels of debt, and that's one of the things that's constraining the ability of the euro area to grow at the sorts of rates we saw prior to the global financial crisis. And indeed, those high debt levels are probably likely to constrain Europe for some time. It varies across the different countries, and the different countries are performing quite differently at the moment. One of the interesting things in that regard is, although the Spanish government's got fairly high debt levels, the Spanish economy is now showing the strongest signs of improvement in recent times. And those debt levels are certainly something that will potentially constrain Europe as you look further forward. But they're certainly one of the things that we've seen in recent times is that it does appear that they are all manageable. Bond markets are treating these countries as all having sustainable positions, at least for the moment.
Thanks for your time today, Paul.
Thank you very much.